In spite of the ravaging economic downturn that emerged as a result of the effects of the health crisis, 2020 has ended with stock markets registering record highs. The evident disconnection between Main Street and Wall Street is making financial strategists argue that the hysterical market speculation is inevitably going to lead to the burst of the epic stock market bubble. Although it is impossible to predict the exact time a crash will occur, by analyzing historical patterns, experts can see that it is coming, and the more the bubble continues to be inflated, the sharper the crash will be. That's what we're going to investigate in today's video, so stay with us and don't forget to leave it a thumbs up, share with friends, and subscribe to our channel to keep updated with the next unfoldings of the U.S. economic collapse. 2020 was one of the toughest years for the economy in all United States history. Nonetheless, the year ended with the S&P 500 up by 16%, which corresponds to a near doubling of its average annual return since 1980. But considering that since the beginning of 1950, the S&P 500 has experienced 38 separate market corrections of at least 10%, it is possible to see a pattern of at least one sizable move lower in equities every 1.87 years. Which means that even though no one can tell for sure when a crash or correction will happen, how long it'll last, or how sharp the decline will be, it's always possible to see when one is coming. Despite being run by numbers and rates, the markets are primarily conducted by subjective terms, such as investor sentiment and the development of current events. Therefore, we can't predict a precise timeline of when a stock market crash will occur, but we can definitely look to history for some practical guidance. According to Motley Fool's investment advisors, one of the telltale signs that currently indicates that big trouble is on the horizon is the Shiller price-to-earnings ratio, which is based on the average inflation-adjusted earnings from the past 10 years. With more than 150 years of history, the Shiller PE ratio for the S&P 500 has an average of 16.8 and a median of 15.8. Now, at the current stage, the Shiller S&P ratio for the S&P 500 is 34.5, over double its historic average. Traditionally, when the Shiller index hits above 30, bad things follow. Of course, no one could have seen that a global virus outbreak would fast spread and uproot the longest bull market ever recorded. But history is pretty clear that when equities become roughly 2 to 3 times as pricey as their long-term average, a crash is followed relatively soon thereafter, pointed out Motley Fool's Sean Williams. According to billionaire investor Jeremy Grantham, the long bull market run on Wall Street that has been developing since 2009 has now turned into a full-fledged epic bubble. Grantham mentioned that the 30% recovery of the benchmark S&P 500 from the March 2020 lows might indicate that the bubble is likely to be inflated for longer than usual. But the unsustainable overvaluations won't last for much longer, and soon the bubble will burst. In a note titled "Waiting for the Last Dance," the investor alerted that this bubble will pop in due time, and even the U.S. Federal Reserve will not be able to impede its destructive effects from disrupting the economy and investors' portfolios. The S&P 500 index has increased more than 455% since the closing level of 676.53 points in March 2009, when the previous financial crisis blew up. The index has generated 14.39% 10-year annualized returns and ended the year 2020 at 3,756. That's why Grantham anticipates that the longest this bubble might survive is until late spring or early summer, coinciding with the broad distribution of the vaccine. He recommended investors not to wait for the Goldmans and Morgan Stanleys to become bearish, as it can never happen, and if they don't start varying their portfolios and preparing for the crash, they might be caught off guard and see their earnings irreversibly wiped out. Last year, after the U.S. stock markets fell into a bear market in the face of the first massive wave of confirmed virus cases and the consequent lockdowns that were instituted in most of the countries to curb contagion, the investors said not to be at all surprised that since the summer, the market has advanced at an accelerating rate and with increasing speculative excesses. He advised that this is what investors should await from a late-stage bubble, an accelerating, nearly vertical stage of unknowable length, but typically short. Even if it is short, this stage at the end of a bubble is shockingly painful and full of career risk for bears, he warned. The billionaire investor considers this as a late stage of a bubble because prices keep moving further away from the trend at a sped-up pace and with a mounting speculative frenzy fueling the growth of the bubble. Grantham disclosed that today's market is presenting dramatic disparities in value by asset class, sector, and company. He explained that those at the very cheap end include traditional value stocks all over the world relative to growth stocks. But value stocks have undergone their worst ever relative decade ending December 2019 with the subsequent worst ever year in 2020, with spreads between growth and value performance at an average rate of 20 to 30 percentage points for the single year. Not surprisingly, we believe it is in the overlap of these two ideas, value and emerging, that your relative bet should go, along with the greatest avoidance of the U.S. growth stocks that your career and business risk will allow, he said. His doomsday prediction comes backed by a historical comparison of the current market to the South Sea bubble, the stock market crash of 1929, and the tech bubble of 2000. Grantham maintained that extreme overvaluation, explosive price increases, and hysterically speculative investor behavior will make this event as one of the great bubbles of financial history. These great bubbles are where fortunes are made and lost, and where investors truly prove their mettle, he added. In his view, the success of a bear market call is that sooner or later there will come a time when an investor is pleased to have been out of the market. His note outlined that the market is much higher today than it was last fall, when the economy was still on track and unemployment rates were at historic lows. Today, the price-to-earnings ratio of the market is in the top few percent of the historical range, and the economy is in the worst few percent, he said. Just as Grantham, several wealthy investors are already aware that a market bubble is here or at least near. For that reason, it's already possible to see how many of them have been playing the markets on a different note. According to a new survey from E-Trade Financial, just 9% of millionaires surveyed think the market is nowhere near a bubble. As for the rest of the affluent investor group, 16% think we're fully in a bubble, 46% in somewhat of a bubble, and 29% think the market is approaching one. Additionally, the survey revealed that market volatility is being considered as one of the most riskiest factors, with 18% of millionaires viewing it as the biggest portfolio threat. The apparent inconsistency of continued bullishness at a time of rising bubble fears is defying every risk thrown at the markets as experts continue to defend the path of least resistance is up. That is to say, the market bubble is predicted to still move much higher before the burst, but if the economy fails to catch up with record-breaking valuations, one of the world's top market experts, chief economic advisor at Allianz and president of Queen's College, Cambridge, Mohammed El-Arian, has warned that there will be serious and widespread unintended consequences if global output fails to return to pre-outbreak levels. He stated that there is no doubt that company valuations have become massively disconnected from the economy, and that the enormous amount of stimulus money issued by governments and central banks is inflating shares instead of actually boosting the economy. Similarly, David Neuhauser, managing director of small Chicago-based hedge fund Livermore Partners, has affirmed that Biden's spending plan could reconstruct the same financial conditions witnessed in the run-up to the 1929 Wall Street crash. His comments arrived shortly after Biden described the details of a $1.9 trillion rescue package designed to assist households and businesses through the health crisis-induced recession. Neuhauser noted that Biden's spending plan seemed to be an attempt to emulate the Roaring '20s by quickly reinserting people back into the workforce. But beware, the Roaring '20s led to the 1929 stock market crash and the Great Depression. So be careful what you wish for, he warned. When asked whether investors should be worried that the president-elect's spending plan could prompt an event like the 1929 stock market crash, Neuhauser answered, "I think so. You are seeing this massive $1 trillion deficit spending due to the health crisis that has, of course, stopped the world in the past 9 months. We still don't know the dynamics as to how fast and swiftly we come through this. We also don't know what global growth will look like in future years, too." Neuhauser said this in an interview with CNBC's Squawk Box Europe. In the aftermath of the 1929 stock market crash, the S&P 500 dropped by 86% in less than 3 years, and it took almost 3 decades until it passed its previous peak. That was 1954. Right now, the stakes are much higher. The stock prices are at all-time highs, and both the Dow Jones and Nasdaq have just registered a fresh all-time intraday high during the previous session. As investors are still trying to figure out which narrative they should go with, and for the past 10 months the markets have been almost in a straight line up, Neuhauser defended that the speculation trend will continue to expand, regardless of the multiple reckoning day predictions. I think what ends up happening is that there will be so much built into the market, we will eventually start to see factors of inflation take hold. Those are the things that ultimately pop the epic bubble, he concluded. In other words, markets are inevitably headed to a crash, whether the pop happens as a consequence of the massive inflation or investor delirious speculation. Historical patterns outline that the system is set to a correction, and bearing in mind that we're at highs much higher than what was recorded in previous crashes, we're about to watch the steepest market decline ever, which will trigger catastrophic consequences for both the economic and the financial sector. At this point, it's just a matter of time, and we aren't exactly short in determinant factors that could suddenly explode and blow up the markets with them.